Welcome to the only podcast video version. As we just heard something come through in my messaging, but Gerry, how you doing?
I'm well. How you doing, Doug?
I'm all right. So we are on
Don't
episode,
put
I
a
think,
lot of emphasis on that. I'm all right.
yeah,
I'm all
you're
right.
here.
We're here.
We're here.
This is my version of Doug.
We're going to play around with the format today, and we will first want to start with a brief market update. Gerry, you want to talk about the interest rates?
Interest rates have peaked.
Interest rates, what?
Have peaked.
It's peaked.
I think they've peaked. I think
Let's
it's.
hope
I
so.
think. I think it's. I think it's over. I think the Fed will. We will soon find out that the Fed is going to backpedal the other direction now because they've overshot. They were too late to raise. Now they've raised too much. Probably slowed the economy more than they anticipated. Even though them wanting to slow the economy is insanity. Economic growth would eat up all that extra money supply that's caused the inflation. But I do think I think they've peaked. I think we've seen the height.
How long do you
Um,
think? Again, we're getting into predictions here, which is
yeah,
dangerous.
don't like to do.
If you had to guess, though, do you think they're just going to keep them here for a while, or reduce them soon?
Yeah, I mean, I think. Well, the market has predicted in a May cut. I think it's very possible, if not likely, it's much before that, because I think you're going to start seeing much, maybe even negative inflation numbers. Um, and perhaps much slower numbers on the economy. So then they'll start to panic in the other direction. And what I hope doesn't happen is that they end up going back to 0% interest rates again. I mean, but that's a risk. I mean, we've gotten into this negative feedback loop of everything revolves around the Fed, and everything they do is you know you know controlling the economy is their thing. It's all wrong, but it's it's the hand we're being dealt. We got to play it, and that's just the way it is. So I wish they would get out of the way and just be in the background and give us price stability. They've given us anything but that. And I don't want
So,
to say that it's all completely their fault. Massive drunken spending by politicians has obviously been the much bigger aspect of this. But as Dick Taylor said, and I've said many times on this podcast, we get by in spite. And what's that spite? It's that policymakers will make mistakes over and over again. So but I do think now that that rates have peaked. I think it's unlikely we will see any higher rates. The bond market is telling us. And the other thing that's important to keep in mind now, and this is getting a little in the weeds, but generally, so many people say, "Oh, inverted yield curve," which means the longer term maturities are lower than shorter term maturities, and so that inversion means there's a recession coming, or that we're even in one. What I think is actually better at determining whether or not there's a recession coming is what we call credit spreads. How much higher do lower quality fixed income notes, in other words, bonds, how much higher are they than quality? So if you think of the spread between, let's say it's, a company that's a lower quality company goes to borrow money and they have to pay 15% interest rate, and the treasury for say a 10-year note, and then the 10-year treasury is trading at 3.5. That's a huge spread. That's extreme. The spreads between the lower quality and higher quality bonds or notes is actually right in line with relatively normal economic growth. And that's usually a really good indicator when you see that spread between quality and less than quality get wider. And we're not seeing that right now. So that would tell me that it's likely that we can end up with a reasonably soft landing, and the resilience of the economy continues, and through just about everything policymakers can throw at it to screw it up.
all right.
So
And
I'd say that's the general market update. And if we're right about that, then we probably are seeing, we'll probably see the end of this, bear market and risk assets, i.e., growth companies and the like,
particularly small cap growth.
particularly small cap growth, an area which has hurt us on our growth side of the equation. Probably means most major and most of the major commodities. I mean, people aren't seeing it yet as far as what they pay at the grocery store for food and what have you. But energy's come down. We are seeing that in the gas prices. They've come down. Is it going to get back to where it was anytime soon? No. I mean, that would take now negative inflation for a fairly long period of time, which is not likely. That's the sad part of this, is that you end up with these prices. You have a bout of inflation, and prices go up. Well, okay, now inflation is ending. We're not getting higher prices, but it's not like they're all reverting back to where they were pre this inflation run. So
Ratchet generally only goes one way.
correct, unfortunately.
All right. So there's the market update. And